Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka. It's been a very sluggish day for the market, so to say. We were in the green zone, but as we speak, we are at the low point of the day. In fact, the Nifty is below that 26,050 mark as we speak. But the big, in fact, the thing that has been happening in the last few days is the weakness in the broader end of the markets, and that continues, right? Because look at the mid-cap index; it continues to underperform the broader indices. Even last week, the mid-cap index, lagged the benchmark peers. In fact, on Friday itself, we saw the mid-cap index skidding over 1% or so. Today as well, it's down almost 0.5% or so, 180-point cut on the Nifty mid-cap index. It has dragged down the advanced decline ratio, which is looking extremely poor at this juncture. In the last few days, we've seen the breadth being extremely poor, and that's why portfolios are not looking all that great, even though the benchmark indices are on the verge of hitting fresh highs, just about 1% or so away from its all-time high. The breadth 1:3, that's the advanced decline ratio, just about 785 gainers to 2,150 decline. So quite poor, and that pain, of course, is being reflected in the broader end of the markets. But sectorally, IT, of course, is holding out. Some brokerage notes coming out. Motilal Oswal, in fact, has turned mild overweight on IT. Last week, IT was among the top performers. In fact, if you look at the month-to-date picture, the IT index is up almost 5%. So yes, IT has been showing some green shoots. And banks, of course, holding out in a weak market, but they are all off their day's high. The Nifty IT index was up somewhere around 1.5% at one point in time. It has paired its gains. In fact, now just about 0.7% kind of gains coming in there. The Bank Nifty as well, it was showing a fair bit of strength, cooled off from the day's high, but nevertheless holding out in the green. That's the Nifty Bank Index for you. If you look at some of the individual movers, then some of these metal names not doing all that well. If you look at JSW Steel, that's down 3%. Even the defense names have come under pressure after the Tejas aircraft crash that happened on Friday. We are seeing the likes of HAL, BEL, all of them under pressure. In fact, Bharat Electronics down almost 3%. HAL was also down quite a bit. Max Healthcare, that stock is also down 2%. You've got Tata Steel, Coal India among the laggards. You've M&M, Ultratech Cement, Tata Motors passenger vehicles saw some bit of green on Friday, but once again succumbed to selling pressure, and so is the case with Trent. That stock is under pressure. On the flip side, IT names and auto names also dominating the gainers list. So you have two-wheelers that are doing well today, the likes of Eicher Motors, Bajaj Auto, and from the IT pack, you have Tech Mahindra that's topping the charts, 2.5% gains there, but that's also come off from the day's high. The likes of Wipro, Infosys, these are some of the other gainers. From the banking lot, you can see ICICI Bank among gainers, Kotak Mahindra Bank among gainers, and also Shriram Finance continues to do well. All in all, that's the texture of the market really. Not such a great start to the week, so to say. At the low point of the day as we speak, we've slipped below the 26,000 mark as well. So yes, some bit of a pressure coming in there. So, not a great start to the week, although global cues, they were fairly upbeat on the back of renewed rate cut bets in the US come December. There's a New York Fed president, who made a comment that perhaps there could be a 0.25 percentage point rate cut on the table. That propped up stocks across global markets, including the Asian markets that saw steep losses last week. Even the US markets saw good traction. US futures were also trading in the green, but of course, our markets, not really participating today, sitting out. 80-point cut on the Nifty at the low point of the day. So that's the market texture for you. But let me bring on board our guest for today. Joining me is Asit Bhandarkar, Senior Fund Manager Equity at JM Financial Mutual Fund. Asit, welcome to the show. Great to be chatting with you this afternoon. On the headline indices front, we are near all-time highs, but broader end of the markets has been underperforming, right? Consistently so in the last few sessions, and that's evident in the kind of market breadth that we can see. So what's been your investment strategy at JM Financial Mutual Fund right now? Are you guys looking for the safety of large caps? Are you guys paring your mid-cap exposure? What's the sense, especially post-earnings, and how are you positioned over the next quarter or the next couple of quarters?
Sure. Sure. Good afternoon, everybody. Good afternoon, you as well. So at our end, quite clearly, I think what we've been sort of grappling with is do we go and chase low growth stocks just for the safety that they provide on the large cap segment? Or do we continue to focus on high growth segments? Because structurally, India is in a sweet spot. Macros have never been better. And it's probably a matter of time before we start seeing a broader reflection of growth in the economy. I think the points that you earlier mentioned in your, in your earlier commentary, I think quite clearly pointed out to the fact that markets have been very narrow. Few large cap stocks have done really well, and those have pushed market to almost an all-time high. Our feeling is, given the way we've seen the Q2 numbers play out and what we are expecting from Q3 and ahead, quite clearly, I think the earnings growth trajectory is now looking up. We've seen the highest earning growth on a quarterly basis after 7 quarters. I think for the first time after 7 quarters, we've crossed 15% growth, profit growth on a YOY basis on the BSE 500. And after 5 quarters, we are again seeing the small caps on a YOY basis grow much faster than the large caps in particular. That said, our view on the whole market is that the earnings deceleration cycle is sort of behind us, and we should gradually get into an earnings upgrade cycle as we get into next year, driven by all the positive macro events that have happened this year, including the rate cut, the tax rate cut, GST cut, liquidity improvement, etc., etc. So all in all, from our perspective,
Hmm.
what we are doing is we're playing the patience game. We are trying to stick to high growth
Hmm.
small caps and mid caps as well in our portfolio. And we are trying to communicate to our investors that, that probably is the right thing to do as we look into 2026.
Hmm. Okay, that's the view. But let's shift focus to some sectors. Then IT stocks have been hogging the limelight in recent times. Last week, of course, they were among the top performers. This morning, of course, there is a brokerage note wherein they've pointed out that IT may be at the cusp of a major shift, driven by the next phase of AI spending. A lot of spending has been done in chips and infrastructure, etc. But now all the spending will be directed towards software services. In that sense, Indian IT companies stand to gain. What are your thoughts looking at the numbers? Numbers weren't as bad as the street was anticipating, large cap IT wise. What's your sense? Do you find value in some of these larger names which perhaps have valuation comfort compared to the mid cap ones which have run ahead quite a lot? How are you looking at the entire spectrum, and do you feel that large cap IT is poised to benefit from the next wave of AI spending?
Yeah, at the margin, I think other fundamentals apart, there's no doubt that these are very well-governed companies generating very strong cash flows. And yes, they have seen a lot of disruption, in their journey all across the years. The fact is that, AI does disrupt some of their offerings, but it also brings opportunities which are far bigger. That said, I think the near term, I would think that these stocks have lagged significantly on a cash flow yield basis. The sector does look very attractive, and we have to remember one thing, that the rupee has also depreciated, and IT stocks to that extent do benefit out of a rupee depreciation. India as a whole and also our IT sector remains one of the best anti-AI trades if that were to ever happen. There is a general feeling that probably the AI rally has been overextended globally, and there are serious questions
Hmm.
being asked about the capex and the returns that can be generated from that capex. So I think in all this context, IT does look
Hmm.
interesting, but I must just put a caveat here that we have seen several such sectoral rotations through the year. I think what we have to see is the most durable sectors that have sort of, and that do look promising over next few months, clearly remains the consumption sector. And also banks, after a long time of underperformance, financials particularly, I think are also looking quite okay.
Okay, so financials per se is a quite a wide universe, right? Which end of the spectrum would you be tilting towards? Tactically, would you look at PSU banks? Do you think they are better poised in terms of margins? And of course, all the spate of
Uh,
good news as well. That's not really happened yet, but that could happen. Higher FI limit, and then banking consolidation as well going forward. So, in that sense, would you be tilting more towards PSU banks?
well, ma'am, I skip the details here. What I would say is, as a fund house, we are growth focused. And wherever the growth is higher and with a fair bit of visibility, we tend to be invested in those segments. In your particular context that you mentioned about PSU banks, yes, we have seen PSU banks come back very strongly on credit growth this quarter, and in some cases even a little better than the private banks. Asset quality remains pristine, and valuations are not very expensive.
Okay, so what about high growth names like the new age companies for that matter, Zomato, Swiggy, etc. And they are all in focus today given the new labor code that came into effect, and these have raised concerns over high operating costs for platform companies as well. So, what's your sense? Do you think that will prove to be a major headwind, or do you think it'll all get the costs will all get distributed, and that would not prove to be so detrimental when it comes to EBITDA margins going forward? What is your take?
I think it's a little early for us to comment here because the code just came out over the weekend, but and it's not even actually implemented. But that said, I think in general, if you see, one of the things that has been troubling us as an economy, that wage growth particularly had been lagging the profit growth meaningfully and the sales growth over the last few years. Perhaps it was the outcome of COVID and whatever happened after that, and maybe also a fair bit of digitization that has happened subsequently and automation. So it was worrying for us, and I think broadly, if I just step back and don't get into company specific things, I would think having a stronger wage growth would be a positive for the demand in the economy. See, we're just on the cusp of a focus on consumption, particularly if we look at all the government policy, and a positive wage growth should be a very strong trigger there. Also, I think the fact is, in the long run, wages and labor won't cut it if we are to become the factory for the world, and probably this will also push us as a country more closer to automation. So I think I see only positives coming out of all this, and the companies that you mentioned, etc. These are very innovative companies, and we have seen them come time and again out of various such cost challenges. And I think the models have also evolved when we see that how dependent we have become on some of the services that these platform companies provide. I'm sure people are willing to pay a little more.
Okay, and are people willing to pay a little more for some of these recent IPOs that are commanding very high valuations, and they have a lot to show for those valuations that they are commanding? And of course, it'll be an uphill task. But is this the right time to pay such a price for these companies? What is your thought at GM Financial?
We are very careful actually when it comes to IPOs, particularly it's less the function of valuation, it's more the function of understanding of the business itself. That's been our approach in general. And there's been a lot of debate, and as we have seen in the past, that whatever debate we have seen debates for some of the companies which have been listed for a few years, and some have done really well and some have not. I think that's the name of the game. I think the companies which have got listed will have to perform. They will have to perform at with because when you get listed at higher valuations, the expectations are very high, and you will have to work as much harder to prove yourself. I guess it's a constant battle in that sense.
That's true. Of course, time will tell, and of course, one has to understand the business first before ruling out such a price for these companies. But let's talk about an exclusive news from our network. CNBC TV 18 reported a while ago that the government is likely to permit merger between insurance and non-insurance companies. Government's move, of course, could pave way for the merger of the likes of Max Financial into Axis Max Life. Insurance per se, what has been your call post the GST rejig because of all the input tax credit that would have gone away because of zero GST? How are you looking at this space, and are there any are you veering towards life, non-life? What is your take on this entire sector?
I think the bigger take is that insurance penetration is a long way to go in this country. And anything that contributes to affordability and better governance should always be welcome. And if we see the pattern that we've seen with other countries which have gone from a developing status to a developed status, one of the biggest beneficiaries of that are the insurance companies with higher penetration. So we do look at this space as a high growth space. That said, we are pretty selective because there is a lot of competition in this business, and very few companies are able to justify the kind of valuations that persist. And we closely watch for delivery from the larger companies here, both on the life and the non-life side. We've seen, on the non-life side, various bit of challenges that have come through post-COVID. But that said, even on the life side, I think, affordability coming through better because of GST cut should be a positive thing ahead in the industry, in the prospects for the industry. We'll see how the delivery happens because there are various challenges in terms of input, credit, etc. That was probably discussed earlier. But that said, I think overall, from affordability perspective, it should be a positive, and that should probably start getting reflected in the growth of these companies as well.
Okay, so what else do you like within the consumption basket? QSR, that's an interesting space. Your numbers, when you see, the likes of Jubilant Food, etc., looks like the like-for-like growth was good. Same-store sales growth not all that bad. A couple of deals also brewing. We've spoken about that in recent times as well. Would you be enthused by this space? And if not, then staples, discretionary, which end of the spectrum are you tilting towards?
See, we are looking at consumption as a basket, and quite clearly, I think, as per capita income goes from $2,700 or something where we are to over 5,000 in the next 5, 6 years, I think, consumption patterns will change. I mean, it won't be so easy to just play some legacy businesses and make serious growth efforts. So as I explained earlier, we keep looking out for growth, but and obviously we do see QSR as one of the beneficiaries of the growth in consumption, because consumption patterns will change. People will eat more outside. We know all those things. But that said, it has been a challenge, particularly for these companies, because delivery of some of these platforms which deliver food and restaurant food to your houses, they have been a serious competitor, and cloud kitchens, etc., to these businesses. So we are very selective here. Some of these businesses are very high quality franchise, great brands. But that said, getting profitability and growth has been quite a challenge. we have seen one particular thing that most of these franchises have grown meaningfully in terms of footprint. There has been a sacrifice on profitability, but if you just see the store locations, I think in last 5 years, most of them would have doubled. And they have mostly done it through internal cash flows. So that enthuses us, but we are yet to see a meaningful turnaround in same store sales growth, etc. But given the current context where
Okay,
the way
still need
consumption
to
is
see
being
many.
encouraged, we never know.
Okay, got your point. But any other themes apart from consumption that you guys are looking at? You said that you guys are looking at high growth themes. We spoke about a few, but if I were to ask you to list out three, which ones would they be?
We're very, very excited about the manufacturing out of India, actually. Themes like EMS, etc., continue to excite us because there are, also we look at China plus one opportunities all along. We see that world is looking at India to be a durable option when it comes to, supply chain for its own supply chain requirements. So other than consumption, which really looks like a very strong, durable theme, and financial services, I would think that selective bets within manufacturing, and maybe if the consumption does really pick up, then the private sector capex and its beneficiaries could also be a
Sure.
durable theme. But I would think that's a little into the future.
Okay, taking your point a little into the future, the private capex recovery. But with that, I would like to thank you, Asit, for taking out time and joining in. It was lovely chatting, and I look for more conversations going forward as well.
It was my pleasure. Thank you very much. Have a great evening.
Thanks a lot. You too. Thanks. On that note, take a look at the market then. Okay, we've slumped even further. The Nifty is now below the 25,950 mark as well. 130-point cut on the index at the low point of the day. In fact, now the benchmarks are underperforming if you compare it with the mid-cap index. The mid-cap index is down almost 0.4%, but the Nifty and the Sensex are now down over 0.5% each. Breadth, of course, looking extremely poor, 1:3, so portfolios bleeding as well. But the benchmarks have really taken a sharp turn. After a positive start. Bank Nifty as well has reversed its course. It's down 0.3%. So in the throes of some kind of profit taking. And remember, tomorrow it's the monthly FNO expiry as well. So, few jitters before that as well is being felt. And tomorrow as well could be a fairly volatile session for the market, it being the monthly FNO expiry. But what's holding out, of course, as I mentioned, was the IT pack, although it has paired some of those morning gains. That's up only 0.5% now as we speak. In fact, IT is the only sector that's now trading in the green. All the other sectors like PSU banks, they've all given up their gains. You have real estate pack. In fact, I wanted to ask one question on real estate to a funda guest, but didn't really have the time. The real estate index is down for a fifth straight day, and it is the top laggard today, down 2%. There are some concerns building up on valuations, although experts have pointed out that fundamentals remain intact, but it's the valuations that are running ahead of fundamentals, which is why I think real estate has been under a fair bit of pressure in recent times. Metals, of course, once again down 1.5%. Remember, the dollar index is close to the 6-month highs. I think that's also weighing in on the metal index. It's above the 100 handle, and that's not good for metals, which is why that's also under pressure. Autos 0.5% down, FMCG down almost 0.8%. Pharma also it's down 0.4%. So barring the IT index, all the sectors are trading in the red as we speak. Let's take a look at some of the individual movers then. Just about 6 minutes to go for the markets to shut. It's BEL, Bharat Electronics, that's the top laggard, down 3%. Want to see what really HAL is doing. Although analysts have kept the faith after that crash, and they've said that the order books are strong. Exports could be impacted a bit, but I think it's the delivery timeline that could be impacted. That's what some analysts have pointed out, but they have kept their faith in the stock with buy calls. In fact, HAL at one point in time was down over 7-8% in trade. Right now it's down somewhere around 3.5% or thereabouts. In terms of other movers, then some of these metal names, as I mentioned, dominating the laggards list, the likes of JSW Steel, Tata Steel, Coal India, these are among the top laggards. Max Healthcare is another one that's down 2%. M&M, Grasim, Geo Financial, Nestle, all these are among the laggards. What's really holding out? Gainers list has become pretty slim now. Tech Mahindra, that's up 2%. Eicher Motors and Bajaj Auto, these two-wheeler names are picking up speed in a weak market. Wipro, Adani Ports, Shriram Finance, Tata Consumer, and Infosys, of course, are just about some of those gainers. But Infosys has also come off quite a lot from its day's highs, just about managing to hold on to the positive territory as we speak. But on that note, let me bring on board our technical guest for today. Joining me is Rajesh Bhosale, Senior Technical and Derivative Analyst at Angel One. Rajesh, lovely chatting with you this afternoon. We've completely reversed course. In fact, the Nifty down, below that 25,950 mark as well. Tomorrow we have the monthly expiry as well on the Nifty. How are things looking? Do you think anything has changed on the charts?
Hi, afternoon. So yes, last two session has been of measure of price profit booking since Nifty was trading around its all-time high levels. So some kind of correction is seen in the last two session, especially in the broader markets. If we see the mid cap selling is quite intense, and we expect that this correction can extend in the coming session, possibly towards 25,800 to 25,850. This would be a key level to watch out for because this is its 20-day EMA. So as of now, we are a bit cautious because market Nifty has been moving higher, but the broader markets were not supporting, and today we are seeing a broad-based selling. So as of now, we are cautious. We would be watching how market reacts around the key support levels of 25,800 to 850 levels.
Okay, 25,850 levels become crucial now. But last week when we were chatting with analysts, they would say that 26,000 could be a support, but that's clearly been broken in today's session. But what about the Bank Nifty? It was holding out pretty smartly, but that's also reversed course and it's down 0.3%. Is there a buy and dip strategy on the Nifty Bank Index? If yes, which are the stocks that you're liking?
So in fact, if you see Bank Nifty last Friday, we had seen a evening star price pattern, which is a bearish reversal pattern, because of which prices didn't hold on to the morning gains. And in fact, in the last 1 hour, we have seen a severe selling. So even in Bank Nifty, we expect some further price correction in the near term. Having said that, Bank Nifty has been the major outperformer in the last few weeks. So this correction should be taken as a buying opportunity. Counters such as Axis Bank, IndusInd Bank are the counters which have done pretty well in the last few weeks, and we expect them to perform. So this dip, in fact, would be a buying opportunity for some of the larger private banking space.
Okay. What about real estate? Down for fifth straight day. Today it's down over 2%. What's the outlook there and what are the charts saying? Do you think there's further downside before it finds a floor?
So, reality space has totally not participated in this up move, and counters like DLF, Loda, uh, Prestige, all are under tremendous pressure. So we would wait for any kind of reversal signs or any kind of strength then to enter, because this space is high beta counter, and market is in when market is in correction mode, they tend to slip for more sharper. So we would wait on this space for any signs of strength, but until then we would avoid this space.
Okay, avoid this space. That's the view on real estate. But let's talk about IT as well. IT on a month-to-date basis, I think it's up almost 5%. Last week it was the top sectoral gainer. Today, of course, it has given up most of its morning gains, but it's still holding out in the green. What are the stocks that you like within the IT pack? And would you stick to the large caps, the likes of Infosys, TCS, or would you say that The mid-cap ones look much better on the charts. What are the charts really suggesting about some of these IT names?
Yes, when we talk about a space like reality, metal, or banking that looks a bit weak in the shorter term, we are bullish on IT, on auto space, especially IT, which has done pretty well in the last 1 week. And today as well is one of the key holder of the market. So IT definitely we are positive on it. Counters such as Tech Mahindra, which is a top gainer for today, we expect the outperformance to continue. Along with that, counters such as HCL Tech, then Infosys, all have shown bottoming out signs and are now trading above its key moving averages. So as of now, we are biased on heavyweight IT space. Along with that, persistent as well. It has broken out of multi-week high. So that one counter as well looks good in the near term.
Okay, those two counters, Tech Mahindra, persistent, look good for the near term. But let's take stock of the market close then. We've shut shop for the day below that 25,950 mark. It's a 0.5% cut on the index. And as Rajesh was mentioning, 25,850 becomes crucial now as a support on the index. Taking a look at the sectors, I just mentioned a few minutes ago that IT is the only one that's gaining, that's ended the day in the green, barring that real estate, that's the big laggard, main culprit, 2% cut on that index. Metal index down over 1%, so is the energy basket. FMCG down 0.8%. So all the other sectors largely in the red, and bank and PSU bank indices, both of them were showing strength, but succumb to selling pressure towards the end of the session. In terms of the big laggards, we've already spoken about the likes of BEL and some metal names, and of course in terms of gainers, the list is pretty slim, but SBI Life managed to go past Tech Mahindra to emerge as a top Nifty gainer by the end of the session. That stock is up somewhere around almost 3%. Tech Mahindra, the biggest gainer among the IT names today, 2.5% gain there. Two-wheeler names doing well. So are the likes of Adani Ports, Asian Paints, HCL Tech, Infosys, of course, doing well. There is a bullish note coming in by Motilal Oswal that kind of boosted sentiment for IT names, but in the throes of a broad-based downtick in the market, we saw the IT pack also shedding some of its morning gains. But let's take stock of some of the movers and shakers from the broader end of the markets, because as I mentioned, breadth is looking extremely poor, the market breadth. 3:1, that's the NSE advanced decline ratio. 1:3, I beg your pardon. So yes, portfolios not looking all that great, and that has been the case for the last few sessions anyway. But in terms of the top gainers on the Nifty 500 index, you have the likes of ITI up 10%, Gravita up almost 8%, Asahi India, IKS, Swiggy that managed to reverse course and ended higher by 5%. There were some concerns regarding cost uptick as a result of the new labor cost, but Street says that it will not be such a big headwind for these names like Swiggy and Eternal, which is why I think we saw some of these names staging a very good comeback in the session. M&M Financial, that stock has been doing well. If you look at the last 1 month, that stock has gained 20%. That's among the Nifty 500 gainers today, up somewhere around 5%. You also have the likes of RVNL, NBCC, Aptus. These are among the performers on the Nifty 500 index on the gaining side. On the losing end, you have the likes of Anant Raj Industries, transformers and rectifiers, that's also down 6%. DCM Shriram, that's also down 6%, and so is Siemens Energy. But let's talk about some of these movers then. Rajesh, what do you make of the move in shares of ITI? That's the top gainer on the Nifty 500 index. It's up almost 10%. What are the charts signaling? Is this a momentum stock? Should one chase it, or is it just a one-day move?
So generally, we have seen pattern in ITF that whenever it moves around 8 to 10% for a day, generally next day is followed by further follow-up movement. So we expect this move to extend in the near term. Possibly the recent swing high of around 350 to 370 can be retested. So bias seems to be positive on this counter. This is a momentum counter. On the lower side, if there is any kind of dip towards 310, 305 levels, that can be bought for the immediate targets of somewhere around 350 to 370 levels.
Okay, that's the view on ITI. But I want to talk about two stocks that will be, I beg your pardon, impacted by the new labor code. One is Team Lease. We saw such a smart uptick on the stock. The stock was up somewhere around 11% or thereabouts. Of course, the fact that the more and more gig workers, they will be brought under the labor code. That would of course boost demand, and it will shift more from unorganized to organized sector, right? And which is of course which will boost demand, and Team Lease will be one stock that one company rather that will stand to benefit as well. The stock broke above its 100-day moving average. In fact, I think it did snap out of a 2-day losing streak as well. Are the charts signaling any kind of a turnaround in the stock of a Team Lease? How are you looking at it?
So today we saw swings on both the end. Yes, it did end on a positive note, but in the coming session, it would be crucial to see if there is any follow-up buying. If prices manage to hold about 1700 in the coming session, then possibly the stock can extend further towards 1800 to 1820 levels. So coming session would be crucial. On the lower side, if you see somewhere around 1650, multiple bottom lows is held. So 1650 would be the crucial support for the counter. And once stock continues to sustain above 1700, then there can be a positive momentum towards 1800 to 1820 levels.
Okay. Follow-up move will be important when it comes to a Team Lease. But what just happened to Swiggy? I mean, in the last half an hour, the stock jumped to the high point of the day, almost a 5%. The 4.9% move came in the last half an hour. There was a sharp spike. What did you make of it?
So in the last 1 hour, there was a MSCI reject. So multiple stock had some volume-based volatile moves. Even Swiggy had seen last half an hour strong momentum. So as of now, coming session would be crucial because it has just closed above its crucial moving average. Once it sustains above 410 in the coming session, then possibly further momentum can be expected towards 435 to 440. On the lower side, if we see today, we are seeing some kind of open low Marubozu candle. So somewhere around 380, 385 would be the crucial support. And once it crosses above 415 in the coming session, positive momentum can extend.
Okay, that's the view on Swiggy. But let's talk about some of the volume buzzers as well. I think NBCC was one of them. The stock has seen good traction today. Of course, it has not been doing all that well in the last 5 sessions. Today, of course, we saw renewed action in the stock. Do you think this move will see further follow-up buying going forward? Or what's the thought here? Because the last 5 sessions haven't been all that great. The stock has been flat with a negative bias. Did cool off a bit, I think, after in fact, last 6 months have also not been too great for this counter. How are you looking at it? 116 is where it's at, but do you expect the stock to gain momentum and perhaps look at reclaiming its 52-week high anytime soon in the coming months?
So last 6 months has been a phase of consolidation, and many times we have seen one uptick day and then followed then a lackluster moment in this counter. So again, for this counter, we would watch closely for the levels of 120. It's a recent swing high. Once that is crossed, then we can say there is a cup and handle pattern, and then that can push towards the levels of 128 to 130. So as of now, positive momentum was there, volume was there, but follow-up moment would be required. And once 120 is crossed in the coming session, then we can expect further positive momentum to continue.
Okay, follow-up buying crucial here as well. But let's talk about Mahindra and Mahindra Finance. The stock has been, taking off like a rocket. If you see the last 1 month, it's up 20%. The stock hit a fresh 52-week high today as well. How is the risk reward stacked up here? Would you be looking at it, and should one chase this momentum?
So yeah, we have seen a vertical move from the levels of 310 to 355, and despite broader market sulking a bit, this counter continues to show its relative strength. We expect possibly 375 to 380 levels, but having said that, RSI is a bit in a overbought zone. So buy on dip would be suggested. On the lower side, if we see somewhere around 345 to 348 is some kind of intraday base. So if there is any kind of dip towards 345, that could be bought. And on the high side, 370, 375 would be the immediate targets.
Okay. That's about M&M Finance. But Reddington also saw a good move today. How are you looking at the charts for Reddington? Just want to pull up the charts and see. It was up somewhere around 1.5%. I think came off from the day's high. 289. That's where it's at. How do you look at this stock?
So if we see during the start of November month, there was a strong gap up opening, and then there was a follow-up buying after that. After that, there is some consolidation is happening, but stock prices are holding on to the initial gains of the November month. So bias remains positive on the lower side. If we see somewhere around 275, there is a strong retracement and average support, and on the high side 305 is the immediate resistance, and once that is crossed, then possibly 325 330 would be the next potential target. So overall bias is positive on this counter, and one can consider buy and dip on this one.
Sure. Consider buy on dips on Reddington. Couple of more stocks in GMR Airports. Recently, I think hit a 52-week high today as well. It came close to its 52-week highs, but I think it came off from the day's high. Stock has been doing well. Would you look at a buy on dip kind of a scenario here as well?
Yes, definitely. The chart structure of GMR Airport is very strong. If we see the weekly chart, after a very long time, prices had a close above the 100 levels. And overall, if we see the chart structure, a cup and handle formation is visible on the chart. So, a very strong, very big targets are visible on this counter, possibly headed towards 125, 130 levels. So, any kind of dip towards 102, 101 would be actually a buying opportunity for a very big targets of 125 to 130 levels.
Okay, that's about GMR Airports. Things looking pretty good on the charts. But before I let you go, Rajesh, any recommendations for our viewers? Tomorrow, of course, is the monthly FNO expiry. Anything on the FNO side for viewers and in terms of stocks as well?
So two counters that are looking very positive. One is Tech Mahindra, as we said, IT space is looking very good. In fact, Tech Mahindra was one of the top performer, and the kind of momentum we had, the kind of breakout we saw, we expect the positive momentum to extend. Possibly 1560 is what we are expecting in the near term. With a 1460 stop loss, Tech Mahindra can be bought. The second buy call would be on MFSL. The stock in the recent times had given a very strong breakout, and then in the last 1 week it was consolidating a bit, but today it exactly took support on the 20 EMA and the breakout levels, and then resumed its upside. So MFSL can be bought with a stop loss of 1630. We are expecting a near-term targets of 1770.
Okay, that's the view. Those are the two stock recommendations coming in from Rajesh. Would like to thank you, Rajesh, for taking our time and joining in this afternoon. Always a pleasure, and fingers crossed. Let's hope that we can see a reversal of trend. In terms of the headline indices, at least it crossed that all-time high of 26,277 pretty soon, because all of us have really been waiting for that. But look forward to interacting again in the near future.
Thank you.
Thanks a lot. Well, that was Rajesh Bhosale with the technicals and recommendations, and of course the setup on the charts as well. But before we say goodbye, some stocks on my radar this afternoon. Of course, starting with Infosys, it saw an upgrade to buy coming in, from Motilal Oswal. It earlier had a neutral rating. In fact, it has raised the target price quite a lot by 39% from current levels. That's the level it expects the stock to hit. In fact, this upgrade has come 8 months after it downgraded the stock, citing limited catalysts and little support from valuations. Now, since then, the setup overall has improved, according to Motilal Oswal. And what are the factors that really led to this upgrade? Well, first of all, it believes that transition from hardware-led capex to services-led spending should meaningfully benefit Infosys's discretionary heavy portfolio. It in fact, should also position the company as a key beneficiary of enterprise-wide AI investments. In fact, its proprietary AI stack Topaz Suite and full stack application services capabilities should come back into favor as clients scale broader modernization and AI programs going forward. And at current valuations, the stock is trading near its 10-year average price to earnings multiple and at a 13% discount to its 5-year average. So that, of course, makes the risk reward attractive, according to Motilal Oswal, and it sees more upside risks rather than potential downside here onwards. In fact, it also pointed out that Infosys has raised the lower end of its guidance in both the quarters of the first half of 2026, and that, of course, indicates a steady demand environment and better visibility for the company going forward. Also, the fact that pass-through revenue is expected to be low, that kind of sheds more light on the kind of quality that the revenues would have going forward. Efficiency gains from Project Maximum should also support the company's margins going forward, according to Motilal Oswal. In fact, it has also raised its FY27, FY28 growth estimates, and it now expects 5.5% and 8.5% year-on-year growth in these two financial years, led by demand recovery. Now, aside of this, it has also upgraded the likes of Emphasis from neutral to buy, and there also it has significantly increased the target price from 2,900 rupees to 4,100 rupees. It has upgraded Zensar from neutral to buy and lifted the target price from 730 rupees to 1,050 rupees, and Wipro has also been upgraded from sell to neutral, and the target price here has been increased from 200 rupees to 275 rupees. Aside of that, another pocket that was in focus today was the platform companies, the likes of Zomato, in fact Eternal and Swiggy. Now, they fell in early trade after the new labour code came into effect, raising concerns over high operating costs for platform companies, but then they did well to recover swiftly, given the fact that analysts believe that the long-term financial impact is likely to be limited. In fact, brokerages have also quantified the estimated cost implications for food delivery and quick commerce firms following the mandatory social security contributions for gig and platform workers under the new codes. Now, gig and platform workers have been officially recognized under social security for the first time. Now, platforms must contribute 1 to 2% of annual turnover, capped at 5% of gig worker payouts for social security. Now, analysts say if the mandate provides for 2% of sales, there will be an incremental hit of 150 to 200 crore rupees on the gross merchandise value. Now, analysts have also said that a slight increase in delivery fees cannot be ruled out for customers as platforms adapt to the additional statutory outgo. Now, Morgan Stanley has said that the reforms could increase gig worker costs and weigh on near-term sentiment. It sees an increase of 1.5 to 2.5 rupees per order across food delivery and quick commerce, with a 4 to 10% impact on adjusted EBITDA for major online segments. But it also added that the burden is likely to be shared across platforms, workers and consumers, easing the pressure on company margins. Now, both Swiggy and Zomato also said that they see no material long-term impact on their businesses. In fact, CLSA estimated a net impact of roughly 1 rupees per order for both Swiggy and Zomato's listed parent, Eternal. Now, it expects companies to pass through this gradually to consumers, and CLSA also points out that both firms already provide several social security benefits which should soften the incremental cost load, which is why I think a lot of concerns around cost overruns were put to rest, and we saw a recovery in some of these names. But Swiggy also impacted by the MSCI changes in the last half an hour of trade, which is why we saw a 5% gain on the shares of Swiggy. Well, those were all the stocks that were on my radar, but looking at the market, of course, today sentiment kind of turned around a little. Broader markets, of course, they were already sulking. They have been sulking for quite some time. But, there was a broader sell-off that, came into effect in the last hour of trade or so, wherein we saw the benchmarks slumping a bit further, which is why we saw them end towards the low point of the day. In fact, the Nifty below that 25,950 mark as well. 26,000 has been taken out in today's trade, but tomorrow of course is crucial given the fact that it's monthly F&O expiry, and there could be a fair bit of volatility, so brace for that. But let's see, let's hope that we could see some bit of green returning, because we are all waiting for that all-time high level on the index of 26,277. Came within a whisker of that last week, but didn't really manage to conquer that just yet. But let's see how things really pan out for tomorrow. But with that, completely timed out on this edition of Closing Bell. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates, and we'll see you tomorrow 9 a.m. with the markets. Thank you for watching.